Alright, let's move on to subsequent year consolidation when time has passed. So again, this is the case from textbook page 88 when the parent paid $800,000 to purchase 100% of the sub, and the sub has some assets and liabilities with fair value different from the book values. And the allocation table is on the book, and amortization is on the book too. I don't want to expand discussion here because I explained in the previous video clips. If you want to listen to the detailed explanation, please refer to that video clips. Now let's do the consolidation with the format of the worksheet. The first thing I want to do is to predict the consolidated balance in 2017. Now remember, the parent acquires a subsidiary in 2014 at 1/1. So in 2017, there are 14, 15, 16, 17, 4 years has been passed. So we do consolidation after 4 years. We do not know what happens in between. We do not need to know, but we can still predict the consolidated balance. So let's first predict consolidated revenue. Again, because the parent acquires a sub at 4 years ago, so the parent and the sub's revenues should be added up. So it's basically the parents plus the sub, because the subsidiary's performance should be counted as the whole entity's performance after the acquisition. So again, the revenue and cost of goods sold and everything of the sub is not consolidated with the parent's record only in the first at the date of acquisition, which is chapter 2. In chapter 2, at the date of acquisition, anything that earned by the subsidiary is before the acquisition. So we do not include that in the consolidated financial statements. But after the acquisition date, anything earned by the sub should be calculated, accounted as part of the performances of the whole entity. The same thing happens to cost of goods sold. Let me just add them up, add everything up. But we know that for amortization, we need to look at the annual amortization of the patent, because patent is as an intangible assets. So intangible assets amortize over the remaining life. So the excess the parent paid is also amortized over the useful life through this amortization expenses. So it should be the two added up. And we know there should be an extra $13,000 has to be added up to the consolidated balance, because the subsidiary didn't incorporate the fair value when it calculated the amortization. So as the whole entity, we need to incorporate the fair value excess that the parent paid to the amortization expenses. The same thing happened to depreciation, because depreciation expenses should also be adjusted for any excess paid, but now it's a negative number, so we do not add on to the depreciation because the asset is overvalued. That means the subsidiary take more depreciation of the equipment than it should be, or it should have had, if it knows the fair value, or it has the fair value on its book. So we need to minus the 6 because it's overvalued and the subsidiary take more depreciation than it should be. Equity in subsidiaries' earnings should be 0, and net income is calculated as to the above. Okay. The statement of retained earnings, the beginning balance of the retained earnings should be the parents. This is so because if you look at the parents income statement, right? The parent actually include the subsidiaries earnings from before through the equity in subsidiaries earnings. So retained earnings 1/1 of the parent actually has already included all the performances of the subsidiary before. So we do not need to add the subsidiaries retained earnings 1/1 to the parents, because the parents retained earnings 1/1 already include the subsidiaries. Net income is coming from the above, and dividend should only be the parents because the sub pays to the parent, and the ending balance is calculated. Okay, now the same idea persists. The current assets or any asset number should be the parent plus the sub, and if there is any fair value excess, we need to add them up with the P plus S. But remember, only the unamortized fair value excess will be added. We will see that in a moment. So we add the parents' current asset together. Here, because the information told us that the parent and the sub has intra-entity loans, which means the parent lends some money to the sub, or the other way around. The direction doesn't matter. The things matter is that the two companies lending money to each other, which is only within the whole entity. So we do not add the same idea that any financial statement does not report anything happened between the two divisions. So this is the same idea. Because they lend money to each other, it should be eliminated from the outsider's perspective. So we need to take that out. That's 40,000. Okay. Investment in sub should be 0. We talk about this all the time because double counting issue. The investment basically include the retained earnings 1/1 before acquisition of the sub, and all these years increase of net income and decrease of dividend, which is basically also the beginning balance of the retained earnings of the sub. Basically it's the net asset of the subsidiary and the fair value excess of all the individual assets and liabilities plus the goodwill. So we do not want this to add to the whole entity, because we add the parent and the sub's asset and liability and performances together. We will see this at the end of the video. I'm going to show, or maybe a moment later, I'm going to show how the investment account is composed of. Trademarks are the same. So basically the two companies numbers add up. Right, and there is a 20,000 trademarks fair value excess. We need to add that to the P plus S, but trademarks itself does not depreciate, so neither does the fair value excess. The patent would also be the P plus the S. Right, now and plus the $130,000, which is the excess, minus, because 4 years has been passed, so 4 years amortization of this particular excess. What does this mean is that we want to have the parent's book value plus the subsidiary's fair value equals to the subsidiary's book value plus the fair value excess minus depreciation of this excess over the past 4 years. So it's P plus S plus the excess minus the years that are amortized. Next, the equipment. The equipment is has the same idea. We have the parents added up with the subsidiaries number, but we need to add the difference of the 30,000, which is basically a negative number. So minus 30. But every year this negative 30 is amortized, so we're basically reversing this negative 30 every year by 6,000, and 4 years has been passed, so that's 624. Again, the goodwill comes from the allocation table, and the total assets would be these guys added up. Okay, it's 4 million. Liabilities would be the parent plus the sub. Remember, there is an intra-entity loan happening between the two parties. We need to take that out, which is 40. So we want to take that out. And so we need to take the 40 out of the 40,000 out of the 1.51 million. Common stock again would only be the parents because it's the shareholder of the whole entity. Retained earnings from the above. So total liability plus stockholders' equity would be this. Okay, now we see the asset equals to the liability. We know we pretty much predict a good set of numbers, if not the perfectly correct set of numbers. Alright, next we want to do some mechanical adjustment to make our consolidated number the same as the predicted number. Now this column is only the simple adding up of these two and numbers now, right? Every number is the adding up between the two, but we know some of them are not correct because it's different from the predicted value, so that we need to use the debit and credit side to adjust these numbers. Again, we need to start with the idea of the investment. Okay, so the investment account are the cost and the net income of the subsidiary, the dividend of the subsidiary, and the amortization of the subsidiary, the fair value excess. Again, I just after a couple of years, so this will become the investment at the beginning of the, say, the 17, and the net income of the subsidiary during 2017, the dividend during 2017, and the amortization during 2017. Now I just want to show you a generic formula that we eliminate this investment 1-1 using the S and A entry. And net income minus amortization of 2017, this whole thing is eliminated by the I entry. The dividend is eliminated by the D entry. Okay, and there is an E entry separately taking care of the amortization of this particular year, which is 2017. So here, why do we use S and A to eliminate investment 1-1 2017? We need to look at the investment account from the previous years. So we can see, because this is equity method, the essence of equity method is that our investment reflects the equity changes of the subsidiary. So the S entry eliminating common stock, additional paid-in of the subsidiary, and retained earnings 1-1 of the subsidiary, which is exactly the equity changes of the subsidiary plus the cost of the investment we have paid, partially part of the cost. And the other part of the cost is in this A entry, which is the fair value excess we paid or the parent paid at the acquisition. So the balance of investment 1-1 is basically the cost of the investment plus the stockholders' equity change of the subsidiary, as well as the the fair value excess of the individual assets and liability minus all years of amortization up to 1/1. That's why this A entry restores the fair value excess of the subsidiary's individual assets and liability, but only up to the beginning of this particular year, which is 2017. This I, if you think about it, it is basically equity in subsidiaries' earnings. So it's basically the net income of the subsidiary minus the 7,000 of amortization. The 7,000 of amortization, it would be the 153. And this is the dividend. We want to debit the investment and credit the dividend of the subsidiary. So this is eliminated by the D entry. Okay, so this is why when we are doing elimination of this whole company, we always start with SAID and then the E. If we have intra-entity transactions such as intra-entity loans, we use in this case we use P entry, which is the intra-entity payable accounts. So let's start with the S entry. Okay, mechanically speaking, now you should be very familiar with the elimination process. So the S entry always start with the beginning balance of the retained earnings of the subsidiary and common stock and retained earnings. Okay, so these are the S entries. At the same time, you want to add them up, and it become credit your investment account. That is our S entry. You can see this will eliminate investment 1/1 of 2017. The A entry will be the 20,000 of the trademark and 130,000 of the patent increase. But remember, A entry eliminates fair value excess, restores the unamortized fair value excess up to 1/1, so it should be 130, but after amortizing it for 3 years. Now 2017 is the consolidation at 2017 is the consolidation after 4 years, but we are eliminating using the A entry only up to 1/1/2017, so you want to multiply it by 3. Okay, I want you to remember this. You don't multiply it by 4, you only multiply it by 3. The other one, you should be, now if you look at the ending, the predicted number, it is 4, but the A entry only takes care of 3. Where is the other one? It is here. Okay, it is your E entry. The E entry will have 1 year of amortization, which is the 1 year of 13, and it's on the credit side, so it's another -1. Okay, but let's do it one by one. So I'm going to do this A. Equipment is the same, but it's on the other side because it's a overvalued asset. So I want to do a 30 minus 3 years of the 6 that we are amortizing. Okay, so that's 12. Goodwill 80. Okay, so we don't have anything else. If we look at here, we don't have anything else. We have trademarks, patent, equipment, and the goodwill. So that's all. We add them up. These two, and this guy, and the negative this guy. Okay, so that's A. Okay, it looks right. That's my A. And next, that's my A. And next I need to eliminate my net income minus amortization of my investment account by the I entry, which is exactly basically the equipment in subsidiaries earnings. This account has a negative remaining balance, so we need to debit this account. And then this is my I entry. I means income, so I do the 153 as my I, so I credit my investment. Lastly, I eliminate the dividend. I reverse what I did to my investment account before we credit our investment account by the dividend we received, so we need to debit it if we want to reverse it. So we want to debit the 40. No, in this case it's 70. So I want to credit the 70 here because it's a positive, it's a debit side balance. So we want to credit it to eliminate it. Again, we want to debit the 70 here. We just want to reverse what we done to the investment account. So after what I did, the investment account goes to 0. That's my I entry. That's my D entry. So SAID eliminates the investment account. Now I need the E entry to, as I said, to take care of this particular year's amortization. For example, here only takes care of 3 years. Now I need another year. It's here. So that's my E, means expenses, and I need a 6 here because it's an overvalued asset, so I need a 6 on the debit side. The same happens to, so I credit pattern 13. I should debit amortization expenses by 13, and I also need to, I debit equipment, so I credit depreciation expenses by 6. Okay, now I still need one more entry, as I said, just to eliminate the intra-entity loans. So I basically eliminate the accounts receivable by crediting the 70. This is called the P, and the 40 here. This is the P on the liability. So basically, when the lender debit accounts receivable, the other side credit accounts payable, we reverse it by debiting accounts payable, crediting accounts receivable. Okay, I want you to see this. That's eliminating the intra-entity loans. Now, after I do this, everything looks great because my consolidated number coincide with my predicted number. Again, my predicted number are the intuitive number that should be the consolidated number of the whole entity. So if you look at my debit side and credit side adjustment, they are the same. Okay, so again, let me summarize it for you. For eliminating the investment account and the equity in subsidiaries earnings, we need to use SAID to eliminate the intra-entity investment and equity in subs earnings accounts, and then we need an E account to eliminate not to eliminate, but to take care of the amortization of the fair value excess of the parents paying for the subsidiary. Okay, I hope you enjoy this video, and if you have any questions, you're welcome to send me an email. Thank you.